Now, I do live off the dividend income that companies pay me. That's my primary source of income. So I'm going to share all my tips and tricks in this video on how to get started. So first off, what are dividends? So dividends are just payments that the company pays to investors for investing within that company. It's actually my favorite form of passive income because once you invest, you keep getting dividends over and over and over as long as you still hold the company. You actually don't need to do anything else, just sit back and wait for them to hit your bank account. Now that sounds easy, of course, but before you get paid, there's a few things you need to get started. Now first, obviously, you're going to need money to invest. You'll also need a trading account to trade through, to put your buy and sell orders through. You'll need somewhat of an idea of what you're going to invest in. Are you going to invest in single stocks or exchange traded funds? And most importantly, you need to have the courage to get started. This is actually the part where most people fail. They're too scared to get started, or they'll put a really tiny amount into the stock market and then freak out when the price starts becoming volatile and pull it all out again without it actually starting to work for them. So let's talk briefly about how the stock market works overall. So at its core, it's just a marketplace where companies come together to find investors, people like you and me, to put money into the company to help it grow. And in return, you'll get paid some of the profits as dividends, or the price will grow over time as the company grows. Usually it's a combination of the both. You get both dividends and growth, but not every company will pay dividends. Now the price it costs to buy a company varies from company to company. There are some that are considered cheap or inexpensive and may only cost a few cents per stock or per share, and others cost hundreds per stock or per share. The price is going to change day to day. It's a marketplace, so it really depends on what investors think it's worth, and that can change and fluctuate quite a lot sometimes. This is going to depend on what's happening within the company, what's happening in the economy, and what's happening in the world overall as to what the price might be doing. But generally, long term, over time, if the company's profitable, the price should go up. And if they pay dividends, they should be paying them consistently over time as well. That's why most people will say that making money in the stock market is a long-term investment, because short-term it's just far too volatile. Some people like to take advantage of that short-term volatility, but I prefer to stick to long-term investing. Dividend investing particularly is a long-term strategy because your goal is to buy once and then just hold forever, so they keep paying you dividends over and over and over again. So how much money do you need to start investing? Now you might be starting with a lump sum, which is great, or you might be starting with zero, which is also fine. When I was starting out, I used to save up $1,000 and put that in the stock market, then save another $1,000, sometimes $2,000, put that in the stock market, and I did that over and over and over again for many, many years. Now these days, you can start with as little as $5 with most of the micro investing apps, but if you're looking at one of the online brokers, the more popular brokers, they usually have a $500 minimum to get started buying a company. Now the key, whether you're starting with zero and saving up and investing, or you have a lump sum, is to keep it consistent over time. Now eventually time itself is going to help your portfolio because the compounding growth of the company as it grows over time is going to help you, as well as the money that you're putting in yourself. But remaining consistently investing over time at regular intervals or with regular amounts is what's going to help you the most. And another benefit of investing consistently over time is as the price changes, as it fluctuates, you'll be able to buy more at lower prices and less at higher prices. So it kind of evens out what price you actually pay. That way you're not trying to time the market. You've probably heard of the saying, don't try and time the market because it's time in the market that's more important. And that is so true. It's time in the market that's really going to do the most help for you, because that's where the compounding growth comes in. Plus it's just so much easier. You don't have to work as hard. So let's talk trading accounts. How are you going to buy and sell those shares? Now you will need a trading account to buy and sell your shares. There are a number of good ones in Australia that you can choose from. They're all quite similar, especially the big ones are all quite similar. So it really depends on what you feel more comfortable with, what one you like the most. Some will let you only trade Australian companies, some will let you trade overseas companies. Usually the big ones will let you trade most of the exchange traded funds and ETFs as well. And some of them even let you do more advanced trading techniques such as short selling and things like that. But you probably just want to start with something simple. Opening an account is just like opening a regular bank account. You provide ID and your details, and they'll open the account for you. Some of them will link your regular bank account to them, and some of them will want you to open a separate investment account. So that depends on what you prefer. Now, the most popular options in Australia for trading accounts, there's CommSec, There's CMC Markets, NAB Trade, eToro, Pearl is another good one, but there are a lot of other ones as well. Now, when you're focusing on which one to choose, this is what you need to be looking at. The first and most important one, I think, is ease of use. You want it to be easy to buy and sell, and you also want it to be easy to get your money in and out of that. If it links to your regular bank account, that's great. That means they'll take the money out of your account and deposit the money into your account when you sell. That's by far the easiest and the one I recommend and prefer. But if they want you to open an investment account, you want to make sure that it's easy to get your money in and out of that as well. Trading fees aren't as important as most people place on it, whether it's $10, $20 or $30. It's going to change depending on how much you're investing, but don't get too hung up on saving $10 here or there, because in reality, if you're a dividend investor, you're likely to be buying once and then holding forever. So saving $10 at the beginning is probably not going to make much of a difference. You want to be focusing on the other factors more. Make sure you have a look at what research tools they have, because that can make a difference. That's why I'm actually with CommSec, and I particularly like their research tools. They do have slightly higher fees, but I like all of the other features that they have. And you want a broker with an established history. You don't want one that's just turned up overnight. You want one that's nice and stable and has been there for the long term. So now you've got your brokerage set up, you've got some money to invest. What are you going to invest in? Now, when you start, you're usually going to choose between either an exchange-traded fund or a single stock. Neither is better than the other. I prefer single stocks. Other people prefer exchange-traded funds. Most beginners start with an exchange-traded fund, mostly because they get that instant diversification, and I think that's fine. Now, if you don't know what an exchange-traded fund is, think of it like a managed fund or a mutual fund, where there's a whole bunch of companies in that one fund. It's like it's a parcel or a portfolio of companies within one fund. It could hold 100, 200, maybe even 1,000 different companies within that one fund. And because you can trade it on the stock exchange like a regular company, that's why it's called an exchange-traded fund. Your aim is to get a diversified portfolio. So that's why ETFs are most popular, because you're getting that instant diversification already, because one trade and you're already holding 100, 200 or however many companies. Single stocks are different. Once you buy one company, you own one company. So your goal is, if you're buying single stocks, to buy a whole parcel of them as well. I like to aim for an amount of over 10 different companies. Currently in my portfolio, I have 4 ETFs and I have 13 single stocks, which is a great mix for me. The reason you want that diversification is just to lower your risk a bit. In case one of the companies goes bad, you don't want to have all your money just in that one company. Now, over the years, this is what I've found. When you're holding a bunch of different companies, 1 or 2 of them may go bad or go down in price or lower their dividends. You'll have a couple that go amazing. They'll start giving out special dividends. The price will grow, sometimes even double. But most of your portfolio is just going to be very average and pretty much just move with the rest of the ASX 200 and not really do that much at all, but just consistently pay and grow over time. And that seems to be the case no matter how good I do my research. Pareto's principle. If you're just going the most simplest route, then one exchange-traded fund is all that you probably need. Try and choose one that's like an index ETF. All of the good ones in Australia pay pretty good dividends anyway, but you could go with a dividend-specific one as well, or just a general index one. If you're looking at single stocks, then what you want to look at, I usually stick to the ASX 200. I'm looking for a high dividend yield of 5% or more. I want the dividends to be consistent and growing over time, and I also want the price to be growing over time. Now, I've got plenty of videos on my channel where I show you how I do the research and list a bunch of stocks or companies that fit all my criteria. So if you want to go and check any of those out and put some of those companies on your watch list, you're more than welcome to. But if you are ready to buy, just choose one from the list. It's really not that big a deal which one you choose. Just choose the company that you like the most, because over time you're going to be diversifying your portfolio anyway and buying more and different companies. So just get started with one of them and buy it, and then when you save up the next amount of money, buy a different company. You don't need to rush this. You do have time to buy all the shares that you want to buy over the long term. Your first goal should be diversifying your portfolio. So getting at least 10 single stocks if you're buying single companies, or 1, maybe 2 ETFs if you're doing that, or a combination. You can have both as well. But diversification is your first goal. And once you have 10, 11, 12, however many companies that you want, then you get to build them up. So once you've got, say, 10 companies, then you can go back and save up another $1,000 or whatever, and put it into the first company, save another 1,000 and put it into the second company. So you're building the value now. So diversification first, then value, and building your portfolio value second. Now, during all of this time, you are going to be receiving dividends. Most companies within Australia pay dividends twice a year, and each company pays in different months. Exchange traded funds usually pay 4 times a year, depending on which fund that you get. I used to curate my portfolio so that I had dividends coming in every single month. I still do have dividends coming in every single month, but there are some months that don't pay as highly as others, because there are some months that are just more popular for companies to pay dividends in. But that's really it. If you want to get started, it's as simple as opening a trading account, getting your mindset and understanding that the price is going to be volatile day to day, but over the long term it evens out. So don't be scared of the short-term fluctuations. Do a little bit of research up front about what you want to buy. I have some videos on my channel on some ETFs that are great and companies that have good dividends. And as I said, your first goal should be to diversify your portfolio to lower your risk, and then you can start building up the value one by one. And then you just wait for those lovely dividends to hit your bank account. Now, when you're starting out, they're going to be small to begin with. They may only be a couple of dollars, but over time they're going to get bigger and bigger as your portfolio grows and as time and the company grows. And eventually, one day, you can have enough in your portfolio to hopefully live off the dividends, or at least get a few bills paid. Anyway, I hope you've enjoyed this video and it's helped you understand on how to get started investing in the stock market for dividend investing. Take care, and I'll see you in the next video. Bye.